Rajesh Bhatia, Chief Investment Officer at ITI Asset Management, joining in. Rajesh, very good morning and always a pleasure to have you with us here at NDTV Profit. Are you worried? The street seems to be worried. Are you worried about what we're seeing with tariffs? Do you think that GST cuts and what we're hoping to see in the next 1 week will in some case mitigate those pains?
Well, there is definitely cause for concern. I think, with this 50% tariff, there is certainly going to be a dent to our exports, especially if it lasts long. See, look, we are in a very good macro environment. The macro stability in terms of current account deficit, our fiscal deficit, inflation, interest rates, balance sheets of banks, corporates, all of that is very, very good at this moment. In fact, that's why we have not seen any sharp equity market correction. India market corrects sharply only when there is a macro imbalance that is caused. So for the moment, at least, the macros are very much in place and it's quite strong. Having said that, the concern that you point out, if we have a 50% tariff, then it can impact our current account deficit because, your exports will lag. And therefore, you will have a current account deficit challenge, manageable, but still much higher than what we are today. You can have a current capital account deficit as well. FIs are anyway not investing in the market. You can have challenges with regard to FDI. The sectors which will be impacted because of this 50% tariff are all employment generating sectors like textiles and footwear. So that brings a different type of a challenge as far as we are concerned, and it may definitely seep into the rest of the economy as well. Now, the counter is, of course, the 100 basis points of interest rate decline that has already happened and the start of what I would call reforms, the GST being the first step. Hopefully, the Modi government will bring in more steps to negate the impact of the tariffs. At this moment, though, the market is not assuming that this 50% tariffs is going to remain for too long. Maybe the market is being a little complacent about that. But at this moment, the assumption of the market and therefore where it is situated or sitting right now is not with the assumption that this 50% tariffs will last very long. And so let's see how that evolves. It's very difficult to call how that 50% tariff will move. But for the moment, the assumption is that these are temporary 50% tariffs and they will go away sooner or later.
Rajesh, good morning. But let's assume that, they may, but if it doesn't happen sooner and happens later, is there a case for some downward revisions to multiples or to earnings estimates and thereby to markets at large? Or does the consumption uptick that will most probably come in post this GST cuts become an antidote to that? And of course, some other moves, right? PM is meeting, I think they're going to address the Indo-Japan Pacific Forum shortly. PM is meeting China, etc. Does all of that become antidotes?
You're absolutely right. In case this lasts for very long, then definitely this is a cause for concern. Look, already, if you look at how we were structured, our profits have done extremely well in the last 5 years, and so has the stock market, right? But profit margins have gone from 9% to 12%. So margins are at a pretty high level. And then if you look at profit to GDP, they were at about 2-3% to GDP. Now they're at 5 to 6% of GDP. I think the top was 7 to 8% of GDP. So even the profit level is at an elevated level. So what do you need to increase corporate earnings, right? Which is the key driver of stock markets, earnings. So to drive earnings, when margins are high and profit levels are high, you require top line growth. Translation, you require GDP growth rate. So with this challenge, we already had that challenge, right? Because if you look at the constituents of GDP, consumption, private investment, government expenditure, exports, already all of those constituents were challenged. This brings in a bit of an additional pressure to grow earnings per share. So my sense is that, the market at this moment is assuming that this 50% tariffs will not last long, but in case they do, there is a downward adjustment that we'll need to make. Also remember that we are at 21, 22 times earnings, which is certainly not cheap. So that compounds our problem with the current macro challenge that we have.
Got it. Okay. Rajesh, what would make you turn constructive? Is there? Okay, let me try and rephrase my question. What is it that you believe the rekindling of the Indo-China relationship, or more overtures that a lot of other nations are making to India and India is making to others as well in the Asian region or otherwise, does for sentiment and earnings both? I mean, the Indo-China thing and the rare earth issues getting resolved is a big bonanza, like, for example, for the auto sector and some of the others as well, right? So there are positives that are happening too. What will make you constructive? What is it that you look forward to this side of the table?
So my personal belief is that other countries' approachment may take some time, and what it does to earnings, etc., maybe more or long duration play.
Got it.
The shorter term impact will definitely be there from the tariffs. So the positive construct will be if the tariffs of at least 25% goes away. Even if we have 25%, I think we can live with it. But if we have a 50%, then there is a pressure. So the one change that would make us very constructive is a 25% reduction on the tariff front, because the other constituents of, let us say, like, you already have an interest rate decline, you already have a good monsoon, rural is kind of picking up, government policies, GST to begin with, all of that is very conducive. So to that extent, I would say that the big catalyst for that change would certainly be the tariff realignment.
In terms of the Indian story right now, so tariffs are at one end, and frankly, it's in nobody's hands. We'll have to just wait and see what happens when India has moved on with its own plan as far as tariffs are concerned. But in terms of domestic-facing companies, and in terms of what the GST impact is going to be, what is looking exciting to you, Rajesh? Are you liking the kind of move we've seen in FMCG players today?
Yeah, I mean, I have my own set of businesses. So there are certain pockets of FMCG which are looking attractive. But having said that, the best way for me to play consumption is telecom. So my largest holding is really a telecom company. And I think there's a lot of tariff repair that is happening. It's not as dependent on the economy or economic momentum. So basically, one is, let us say, something like a telecom. Second would be something like life insurance companies. Again, they are better play on consumption, although it's a matter of investment, but it's still a good consumption-oriented play as you move forward, as far as I'm concerned, because these are, again, companies with very significant moats. And, a lot of the regulatory overhang that life insurance companies had is, I think, behind them. And so now they are focused a lot more on growth. They have grown market share enormously in the last 5 or 10 years, taking away market share from a large public sector enterprise. So my sense is that momentum will continue. So the best way to play consumption, if ever, is, let us say, telecom, life insurance, I would say even automobile, given the GST tariff reduction. So those are my 3 plays as far as consumption is concerned.
Got it. Okay. Rajesh, would you be of the view that one should avoid the, the export-oriented themes completely for now? Or is it too harsh a stance to take?
Well, you should certainly mitigate your exposure. But let's say something like an IT, etc., is now at very tempting valuations. Although the visibility, look, these are all 4% dividend yield, high free cash flow companies, 21 times earnings. This is one of the lower P earnings that you've seen in a very, very long time. Of course, but the outlook for growth, is not very visible, and the acceleration at least is not visible. So there is a challenge as far as those are concerned, but these are all at reasonably good valuations. Having said that, I think it's better to look for domestic-focused growth opportunities. Like I pointed out, like telecom, life insurance, there's a lot of digital commerce companies which are growing regardless of whether the economy is growing at a equally fast pace, because they are taking away market share of consumption into the digital economy. So the digital economy is growing faster than the non-digital economy, even though the cake is not growing as much. So my sense is there are enough growth opportunities in these categories where you can position your portfolio, even though you're navigating a bit of an uncertain economic environment.
Okay. I'm just wondering if you would look at IT banks, some of the large cap ones at this point, Rajesh. Would you stick to true tried and tested?
So IT, like I pointed out, I think it does deserve some weight in your portfolio because these the valuations are really attractive. As far as banks are concerned, again, I'm focused on a bank which is in repair mode and which will accelerate in financial year 27. Again, that takes away this this questions of what will be the credit growth outlook be, or what is the damage to credit costs, etc. That will ensue as you move forward, etc. So let us say large private banks which have been in a repair mode again look very attractive to me. Gold financiers, again, given the backing of the asset is very good on the NBFC platform, those again look reasonably attractive. My point is that there are enough stock picking opportunities that you can do in this market, even though you're navigating an uncertain future or economic growth. We'll see how that pans out, but there are enough things to stock pick, and this is going to be a stock pickers market as you move forward.
Definitely going to be a stock pickers market. What are you finding exciting, Rajesh, then, in this stock pickers market? Are you looking at platform companies as one proxy for that consumption boost?
Yes, you're absolutely right. So, I think digital companies do look exciting to me. Again, the good thing about these businesses, I mentioned telecom, I mentioned some private banks, the life insurance companies, the digital commerce companies. For me, the visibility of growth is there for 5 or 10 years. So this is a very long-term duration of growth that you can look at for these companies, and the competitive moat around them is very, very good. So even there is a shorter-term challenge of the markets, etc. It won't make me move out of the positions because this is still a very, very long duration of growth, and the predictability of that growth is reasonably high. So I'm gravitating towards multi-year growth opportunities, which are very predictable, and I find that in telecom, life insurance, digital commerce, some of the private banks, etc. Those are the good spots to be in.
Okay, thank you so much for speaking with us, Rajesh Bhatia. They're always a pleasure to have your take on, what could be buzzing. Telecom continues to be interesting to him, as do some platform companies out there.